Hello, lovely people out there. How is everyone doing? I'm Kate Hill, and I'm here to give you the best, unbiased, honest commentary about our property markets, along with fantastic hints and tips as we go. So stay tuned. This is a really common question that I get. Keep in mind that one of the main objectives that many investors have in accumulating properties is to build up an ongoing income stream. It's what we call passive income. This is different to getting a steady paycheck from your 9-to-5 job. You would do most of the work up front, like buying properties and paying the loans down, and you may put in some additional effort along the way to earn an income. Passive income is money you earn that does not require you to do a lot of active work to continue making it. Property investments can work really well in this regard. To make it meaningful, you'll need to get an understanding of what net worth means and how to calculate a cash return on that so that you can forecast the level of income that you could receive. Okay, so your net worth is calculated by adding up the value of your income producing assets and then deducting your liabilities, which are usually all your borrowings. Note that while you can use equity in your home to invest or perhaps downsize in the future, I'm not making it part of this particular net worth calculation, as your home is usually not producing an income. Plus, you've got to have somewhere to live, right? So as a really rough guide, let's say you had $3 million worth of investment properties. This could be one single $3 million property. It could be two $1.5 million properties. It could be five $600,000 properties. You get the idea. And then let's say you still have $1 million of debt on those properties. Your net worth would be $2 million. So let's use a conservative cash return on that, let's say 5%. This net worth, as long as you owned those properties, would provide a recurring annual gross income of approximately $100,000. which is a 5% return, right? Now that $100,000 is probably taxable depending on your circumstances, and you do still need to pay property expenses, but that's pretty good, right? So breaking this down, you pay $400,000 for the properties in different and diverse areas. Over time, they grow in value, probably not all at the same time, and you probably won't buy them all at the same time. You might pay more for some properties and less for others, but we're keeping the calculation really simple here, okay? So let's say at the 15-year mark, you have those 5 properties worth $600,000 each. You have a debt remaining on each one of $200,000. The properties have grown in value. That means you have a net worth of $400,000 on each one, times 5 gives you the total net worth of $2 million. Now, while this is a very simplified calculation, what it really shows you is that it doesn't actually depend on the number of properties that you own. It's the size of what your net worth is that really matters. Our calculation shows that you will need a pretty significant net worth to get a 6-figure income in your retirement. But where the number of properties does matter here is your risk profile. And I know I keep going on and on about it, but it's really important. We can't all afford an expensive property that will grow to $3 million. Most of us are in that 5 properties at $600,000 kind of category. And remember, it doesn't mean that you need to pay $600,000 for them. You need them to be worth that when you want to start that income. I would also argue that it is riskier to own just one $3 million property than several smaller, inexpensive ones. We're talking better area diversification, a broader tenant base in the lower price ranges, fewer chances of vacancies, less risk of not being able to pay the loans back, and much more. To invest at this level, you will usually need a timeline of around 10 to 15 years and a financial roadmap in place to get you there. You'll need a strategy that takes into account capital growth, cash flow, and debt reduction. Remember, all those figures I did assumes no debt reduction. And I do really encourage debt reduction. It's also important to remember that most of us don't simply build up a property portfolio of this size overnight. It takes patience, it takes skill, motivation, and most of all, time. Now, I'm going to keep talking to you about all things property, so don't forget to hit the subscribe and the like button if you are enjoying all my free content, and I will see you again really soon. Bye.